In this video, I will explain how banks work and their sources to generate money to run their businesses. How the banks make money is a question a lot of us think about. Investopedia gave a clear answer by defining that the money is made by commercial banks via the provision of loans and the collection of interest payments. The money for these loans comes from customer deposits at the bank. As much as 65% of a bank's income model is based on loan interests. For those who have been following global monetary developments and central bank policies. However, this description paints a somewhat confusing picture. While diversified banks may generate revenue in several ways outside of traditional banking activities, they are still primarily understood to be in the lending business. The primary means by which banks generate revenues by borrowing money from depositors and paying those depositors interest on that money. Banks will then lend this money to borrowers to whom they will charge a higher interest rate to generate a profit. The two primary revenue streams for banks are commercial banking and investment banking. What is commercial banking? In banking, commercial banking describes the goods and services offered to consumers and enterprises. Services in this category include banking, lending, and credit in various forms such as credit cards, mortgages, vehicle loans, personal loans, and overdraft lines. Associated services such as safe deposit boxes, brokerage accounts, financial planning, and others are also included. So now, what is investment banking? When a bank offers services to businesses, governments, and wealthy people that go beyond their standard commercial banking functions, they engage in investment banking. Banks that specialize in mergers, acquisitions, corporate financing transactions, and corporate restructurings are called investment banks. They participate in proprietary stock, bond, and currency trading in addition to facilitating IPOs and debt issues. Additionally, investment banks provide wealth management services to companies and ultra-wealthy individuals. Investment banking and wealth management are examples of banks' non-traditional financial services to customers to create revenue. Banks engage in various revenue-generating activities, but they may be summarized generally as money from interest, earnings from capital markets, revenue from service fees, and funds from interests. Interest rates and their significance. The interest rate is crucial to a bank since it's the primary source of income. Interest is calculated as a yearly percentage of the loan's principal balance, the amount borrowed or deposited. Short-term interest rates are determined by central banks, which manage the level of interest rates to foster a healthy economy and keep inflation under control. However, banks are responsible for managing credit risk, the chance that borrowers won't repay loans. Banks do better when interest rates are rising. The reason for this is that by locking in fixed-term deposits, banks may pay a lower interest rate to depositors while still turning a profit by charging a higher rate to lenders. Because banks are dependent on fixed-term deposits, which are locked in at a higher interest rate, while the interest rates being offered to lenders are reducing, it stands to reason that banks would suffer in a low interest rate environment. And now, some revenue streams of banks. First one, fee-based revenue. For instance, if a customer opens a bank account, the financial institution may regularly assess maintenance charges. Banks assess fees for a wide range of additional services and goods. A few examples of this are expenses related to using a credit card. There are checking accounts, accounts for financial prudence, investment fund earnings, the costs associated with asset management, and the costs associated with having a custodian. Banks may earn revenue from their clients both via the fees associated with wealth management services and the fees associated with specific investment products like mutual funds. Financial institutions may provide mutual fund investment advice to their clients via in-house services. Financial institutions place a high value on fee-based revenue, since it tends to be steady and consistent. It's helpful in any economy climate, particularly in bad times when interest rates can be manipulated and capital market activity drops. Interest. When you borrow money, interest is the cost you pay for convenience. Lending money to people is a service that banks provide, and the interest they charge is how they make money. View some samples of the range of interest rates available in the market below. They change with the time and in response to the state of the economy. There was a record low in 30-year fixed mortgage rates in 2020, with average below 3% for most of the year. When a customer takes out a loan or uses credit, they will pay interest until the loan or debt is paid back. For this example, let's assume the typical interest rate of 10% on a personal loan of $5,000. Over the loan's 2 years, you will pay a total of $5,500 with a $230 monthly payment. As a result, the bank will get $500 in interest payments from you. A tiny portion of the money banks make is used to provide interest to those who have deposits in checking or saving accounts. The banks will retain any surplus funds. Cost of using a bank. Banks generate a sizable revenue stream through the collection of user fees for their various financial services. The fees might either be periodic or one-time. All banking costs should be clearly stated in a customer-friendly location. You may find the charge schedule in a small print of your financial records or online. If you want to protect your financial well-being actively, you should familiarize yourself with the many bank fees. Below, I have included some of the most typical banking fees. Overdraft transactions. If your checking account balance drops below zero, you will incur an overdraft fee. Due to the bank possibly classifying the overdrawn amount as a short-term loan, the borrower may be subject to an overdraft fee and interest accrual on the overdrawn amount. ATM fees. Many factors contribute to ATM fees. There is a good chance you will incur a fee if you use an ATM that is not part of your bank's network. You may incur another fee if you use your bank account at an ATM more than the allowed number of times per month. Charges for overdue payments. If a client makes a late payment, additional fees will appear on their bank or credit card bills. Don't miss a payment by failing to keep track of the due dates shown on your statements, whether paper or digital. Withdrawing fee. For example, if you have a checking account, the number of withdrawals you may make each month may be limited. That's very common in business accounts. The objective of a checking account is to facilitate financial transactions, and some institutions have limits on the number of withdrawals you may make before being charged. However, the federal government only allows a maximum of 6 withdrawals per calendar year from saving accounts. This was all from my side to guide you about the money-making sources that banks use to generate and create money to run their business. Did you know they had so many income streams? Let me know in the comments, and thank you for watching, and see you in the next one.